Okay, so welcome to everyone. Today I'm going to try to talk about performance measurement, and especially performance measurement when you have some ESG strategy. So I don't know if you are familiar, we are not that many, so are you familiar with performance measurement, or is it just brand new for you? Yeah, familiar, so let's take that into account. So the main idea here is that once you have an ESG strategy, you reduce your universe of investment, right? So it has an impact. But also you could say, when I have an ESG strategy, maybe I'm selecting better stocks, and I'm expecting higher return for lower volatility. We that, right? Let's see. It's not about the result here, it's about the methodology. How could we handle, or could we calculate the impact of integrating an ESG strategy into portfolio management? So that's the goal. So first, let's have a quick look. Sorry, changing here. I used to do that. Okay, sorry about that. It won't happen. So let's try to talk a bit about the context. So what's the size of the market? What's the trend on the market? Why people are investing in ESG? So that's first context. Then let's remind us what are the different strategies of ESG. Once we have covered that, we'll go into our goal today, which is performance measurement, essentially performance attribution. So I'll explain, if you're not familiar, I'll explain quickly that, and then what would be a solution, how could we make that work so that we could create a reporting, because at the end of the day, we want also to communicate with our clients what is the impact of integrating this ESG strategy on the performance of the portfolio. When I'm talking about performance, most of the time, it's not absolute return, it's relative return, relative to a benchmark. So what's the market size? So what's the market size? So what we see, Europe is a very highly developed ESG market, which is not the case for the US. Even when we look at the trend in Europe, so it stops in 23, but when we look at the trend, Europe is growing and US is decreasing. So I don't have this first quarter of 2024, but I don't know if the trend is still the same, but we see really a huge bias or whatever in Europe against US. When we look at the trend, we saw a large increase until 21 and then kind of a stabilization. But this may be also a market impact, because when we look at the percentage of ESG fund in the total asset under management, AUM, we see that it's still increasing. So we all believe that ESG is here for a long time, right? It's not just like a fashion or whatever in investment. It's really a trend, and we see that in the number. Okay, so now why we should invest in ESG? Why? Why is it interesting? What are the drivers of ESG investment amongst asset managers? So there is a study here by Capital Group 2023 that shows that when we look at the overall industry, motivation is more convincing evidence showing positive relationship between ESG and performance. That's a huge subject, right? If I integrate ESG in a management decision process, do I improve that risk-return trade-off, right? So it seems that this is for about 42% 2023 that are convinced that they will deliver higher return. But what is kind of interesting, when we look at the ESG investors and non-ESG investors, right? We see that only 39% of ESG investors believe that they will deliver more return, while the asset manager that's still not investing believe that at 69% that they would deliver a higher return. This means that there's still place for new incumbents into this industry. Second, or there is a large list, but I just pick up the two most significant, is greater transparency and consistency in ESG fund reporting framework. Regulation is there, right? We have a lot of regulation now that for companies, we have SFRD, that's for companies, but also for funds, we have more and more regulation for displaying ESG numbers. And also the data provider, they are there today. Still a lot of issue with scores or ESG percentile, right? Because of the criteria. Is it the G criteria that matters more? Is it the E criteria, which most of the time matters a lot? Is it the S? And given that methodology, you could have very, very different classification, right? So still a lot to do over there, but that's not, again, the purpose for this presentation is just about performance. We cannot talk about. But when we see that 43% of ESG users believe that this is a driver to invest, is that we have a regulation framework and we have data that are available. So that's key. And also we see the trend in 2022, 2023 is 40%. Okay, how about performance? Because we saw that performance is a driver. There is a study, the New York Rockefeller Center, they made a report. They cover 100,000 studies from 2015 to 2020, right? So that's a lot of work, right? And they found that about 76% of the study that were long-term oriented, 76% of the study show a better return or neutral against non-ESG strategy. When we look at the short term, once again, the finding, right? When we look at the short term, okay, we have 76%, but on the short term, that's not the case. So it seems that maybe when you integrate ESG criteria, it may be, okay, I'm not saying it is. It may be that you select better company on the long term. Company that are better managed, company that take care of the environment, so that's maybe better for their client. And so that's the finding, okay? So it makes sense to see the industry that is growing, right? Makes sense also to answer this question. Do I deliver higher performance when I integrate ESG criteria into my portfolio? There is also other drivers. Okay, some study shows that integrating ESG do not deliver a higher return, but the trade-off risk-return is better. Okay, which should be the most important thing in managing a portfolio. It's not all about return, as we all know, is the trade-off risk-return. Also, a driver is a driver from the stakeholder, and that will be key in performance measurement. Because if it is the asset owner that decides and impose that constraint to the asset manager, this is not under the control of the asset manager. So he's not accountable for that, right? So that's key in performance measurement. In performance measurement, you want to measure the impact of decision for which the asset manager is accountable for, okay? So that's a driver, the asset owner. The asset owner say, I don't want you to invest in the non-conventional weapon industry, as an example. Also, more and more, there is regulatory support for ESG investment. So we see all these drivers, performance, trade-off, risk-return, pressure from asset owner or stakeholders, right? They are there, and also the regulatory framework are there to show to convince ourselves that ESG is here for a long time. So let's see the strategies. What are the most common ESG strategies? So the first one is to integrate E, S, and G criteria into your management process. It could be done through data, buying scores from a data provider, but also we see more and more asset managers that they have a team, an ESG team within the company to have their own proprietary scores. Just as having financial analysts, right? They have financial analyst team, now they have team for ESG scores. So these teams create a universe that is investable for the different managers, the different portfolio managers, right? So that's a very important point because this decision is under the control of the company of the asset manager, right? So that's the most common strategy, integrating ESG scores into universe to limit the universe of investment. Exclusion. Exclusion is also a strategy that we see commonly. Exclusion, as we all know, is non-conventional weapon companies, fossil oil companies, adult entertainment, alcohol, whatever. I mean, most of the time is the asset owner, the stakeholder pressure on the type of exclusion. Also, you have thematic. I want to invest in water-saving company, in a CO2 or greenhouse gas saving companies, right? So more thematic. We see also a lot of this type of strategies. Impact investing, most of the time on the SDGs, right? Sustainable Development Goal of the UN. Do I have an impact of one of these 18 goals? So that could be also a strategy. I want to have an impact on education. I want to have an impact on health or whatever. There's 18 goals, right? That's impact investing. We see also most kind of integration, but that would be more like I have an order, I take the best, and I invest in the best-in-class company, only the company that I have the highest scores. But that really limits the investment universe, right? And finally, we see that more and more, right? We have the active ownership. There is a story today, maybe you know it, about the group, Total Energy. As you know, the president of the board is also the CEO of the company. So a lot of asset managers today, they have shares through the different portfolio, and so they are going to go to the General Assembly to try to have that separation. So that's active ownership, right? That's something that we see also as part of the ESG strategy. Okay. So when we look at exclusion, because I will focus on that also, sorry, I need to calibrate that. When we look at exclusion, right, we see that once again in Europe, about 61% of the asset manager that use this ESG strategy, about 61% are employing ESG exclusion. And the most common, controversial or forgot the name, non-conventional, right? Gambling, tobacco, alcohol, adult entertainment, thermal coal, etc., etc. Okay? So now that we have seen all the possible strategies, once again, sorry about that. Once we have seen this all different strategy, as I said, once again, it's a matter of limiting the investment universe. And from a theoretical point of view, if you put constraint, normally it should be suboptimal, right? You have less choice. And that could be also a problem. If you don't want to invest in the companies that are today involved in even conventional weapon, I mean, maybe you miss some return. I'm not saying you miss an opportunity, right? I say you miss some return. That's different, right? So that's why I'm saying it's just limiting the universe. So the universe is still large when we have integration, as I said. It's not like best in class. We still keep a large universe. Active ownership also, we still keep a large universe. More focus, there we see the exclusion. So we focus on different sectors, different industries, right? And we are concentrated That's what I say, best in class. I limit the universe, right? Thematic, I limit the universe. Impact investing, I limit the universe. Okay? So I think that we can see the different strategies as strategies that are reducing the universe. And the question is, what will be the impact of this on the return that I deliver to my clients or to the asset owner? To measure it, I need most of the time an index, right? If I would like to measure the impact, I should look at a strategy that has no constraint on the universe, right? And then having the return on this restraint on this limited universe. So I really need an index. But if I take an ESG index, it's already a limited universe, so it doesn't make sense. Okay, so for ESG strategies, I should use, sorry about if there is data provider in the room, but I should use a standard benchmark. There's enough index in the world. I mean, there's so many companies that are providing stocks that are stock market that are providing. But if we look at the theoretical point of view, I mean, if I want to measure the impact, I should look at an investment strategy in the entire universe and compare to that strategy in this limited universe, right? So the choice of the index will be key in performance measurement or in performance attribution. So performance attribution, that's what I'm going to talk now about. So what is the objective of performance attribution? So the objective of performance attribution is to measure the impact of active management decision, right? What's an active management decision? Is limiting the universe. That's an active decision. Is to overweight one specific industry. The benchmark, as an example, let's say in one industry, let's say any industry, okay, the banking sector, right? Banking industry or financial industry to be larger. In the benchmark, it is about 10%. I decide to go 15%, right? I deviate from my benchmark, from the index, so that's an active decision. Performance attribution, I want to measure the impact of overweighting that industry by 5%. What is the contribution of that active decision? Will be the same for ESG, right? For ESG, what is the impact of excluding some industries in my strategy? What is the impact? So I won't adapt to it. I mean, maybe at slides 20, 25, I will maybe adjust to this comment, right? So we need an optimal portfolio. If you're familiar to finance, okay, if you're familiar to the theory, Markowitz, maybe familiar with that or not familiar, but you heard about it, told us that the best investment solution, right, is first the asset allocation. That's the decision I need to take. How much, okay, the theory is very simple, but it doesn't matter. How much I put in a risk-free, okay, monetary account, how much I put on the market. That's the only decision that matters. In real life, it's not like theory, it's more complicated. So we have different asset class, high yield, government bonds, emerging market stocks, European stocks, whatever. Okay, we have a lot of asset class. And theory tells us also that for each asset class, I should invest proportionally to the market cap. So that's why most of the index are constructed based on the market cap. So that's supposed to be my optimal portfolio, what I call a benchmark. A benchmark is percentage, the asset allocation, percentage in different asset class, and for each asset class, I take an index, which has a criteria, most common criteria, that is the market cap, right? So that's the theory. And once you have done that, maybe you allocate to each portfolio managers a budget. This is your budget for European stock This is your budget for high yield, right? And once you have that budget, maybe the asset manager could deviate from the index, and we want to measure that impact. That's what we call allocation effect. That's what we call selection effect. So we don't care about how to measure it. There is a good system. I'm from Amindis. There is an excellent system at Amindis, right? So the benchmark is what we call the passive strategy, right? And active is allocation decision, right? Or maybe more sophisticated, you can decide exposure to different systematic risk, right? Or within each benchmark, security selection, okay? So now let's move into the model, right? Model. That's a good. So most of the time, that's the asset owner. If it's a pension fund, he has liabilities. He has to pay pension over the time. An insurer also has some liabilities. Okay, so he has future cash flow that he needs to meet. It enters the construction of the portfolio. The company has a level of risk that is acceptable. It enters the construction, and they expect a return, right? That's really most common. From that, they decide, as the theorists suppose, they have an asset allocation committee, have a board, they decide which budget will be allocated to every asset class, right? And asset class reflect the risk. If I don't want to take much risk, I won't invest in high-yield bonds, as an example. I won't invest in emerging market stocks, right? So I have what we call the strategic asset allocation, and I can create an optimal portfolio, which is the strategic asset allocation benchmark. An optimal portfolio, 20% of European stock, 20% of government bond, et cetera, okay? That's what I call my strategic asset allocation. And then the asset owner, most of the time, and that's under the control of the asset owner, limit the investment universe through an ESG strategy. It says, okay, I don't want you to invest in, as I call it, the non-conventional weapon industry. I don't want you to invest in the alcohol industry, etc. Is the asset owner is accountable. But now if the fund manager has a team that try to select the best ESG company, right, to ESG integration, that's an active decision under the control of the asset manager. So before we measure that, we need to understand what is under control of the asset owner, what's under control of the asset manager, right? So that's, and once we have that benchmark, no limit, we can create a benchmark that adjusts for this limit that will enter the calculation. Okay? So, once I have decided that allocation to each asset class, there is an index with a return and a risk. And usually, the risk is relative. So, you receive a budget risk, right? The budget risk is measured by the tracking error, or the downside risk, whatever. I don't want to go, there is an entire list of criteria here, but most of the time, relative risk, which is a tracking error, you cannot deviate from your index. You have to reproduce the index, but I allow you to have some difference to try to deliver alpha, excess return, right? Or maybe I'm afraid about the downside risk, so I put criteria on the maximum loss, whatever. But I put some risk measures that are for the first. And once the risk measures are there, the asset manager can decide a different allocation from the optimal. Optimal was 10% in European stocks. Okay, I am a manager, European. I read that in the newspaper this morning. We expect that European will go better than US. I say we expect. I don't even know what's going to happen, right? But let's say we expect. So I will overweight European stocks. I will underweight US stocks. Right? That will be my tactical asset allocation that deviate from the strategic asset allocation, right? And also I have conviction. I think that that stock will perform very well. So I want to overweight that stock. So I have conviction, and I go for stock picking, buying stocks different way than the index. And that's where I have active management contribution that is under the control of the asset manager. Performance measurement is most difficult thing is to understand the investment decision process, right? This is the first step that takes time. You have to understand what is the investment decision process and write it, and who is accountable for which decision. Once you have that, then you can select a model. There is a lot of models available, and I'm going to present today not in the model, not in the equation, but what we could do for ESG strategies or the impact of ESG integration. I propose an example, so not really model. I suppose that as an asset manager, I have a positive screening or integration, right? And also I have exclusion. So I will do first and then combine the two, right? So that's the two most common strategies that we had, exclusion, and then for the remaining industries, I have a team that is trying to select the best ESG company. I need data, right? That's the first, before I measure, and that's key. Don't underestimate data quality. Right? Data quality is key before we start. So we need data. We need index. I think that we could take, I really believe that we should take regular index and then adjust for ESG into the regular index. But as always in management, we have that trade-off, okay? I want to have something perfect, but it costs. So what's the trade-off between perfect model and the cost of that? And I want to present meaningful information. So that's my goal. My goal is not to have the best, the better thing. It doesn't matter. I have a budget I need to do under my budget, and given that, I need to deliver meaningful investor for the portfolio manager and for my client. That's all we are going to try to do. So the attribution number, when we measure what I have explained, the impact of ESG strategy, the impact of tactical asset allocation, the impact of conviction stock picking. When I want to measure all that, I want to have something that is simple, that everyone understands. Because if I need to my client, just saying that you are with your client, you explain what's the alpha, or you deliver return, and you need first 30 minutes to explain your model. He has to understand right away what you're talking about. So that's very important, but it has to be meaningful. Okay, it's not simplicity. Simple means you need to understand it right away. And you need to measure the contribution of each decision. So the importance of understanding the investment decision process, and also you need to reconcile. Means by that, let's say that your excess return is 2%. And you have a contribution, let's be positive always when we present, a positive contribution of ESG strategy, plus 1%. A positive contribution of tactical asset allocation, let's say plus 0.5%. So I already explained 1.5. And then I come with a positive conviction, stock picking, of 0.7%. Doesn't work. I mean, if you're the client, you say, okay, my excess return is 2%, and you're telling me that you're explaining 2.2%. So just forget. Just the people are not listening to you anymore. You said the model is wrong. So it has to reconcile. I mean, that's key. Seems simple, I agree, but otherwise you just talk not about what is important, the investment decision process. Okay, let's move into this example with some numbers. Sorry about that. This is my portfolio. I have some ESG score. They are as percentile here. That's the top 83. They are really in the top 83. Whatever the score, it could be a letter, A, B, C, etc. Right? That's the score, whatever the score. And when I take the benchmark without any constraint, that benchmark is invested in all the stocks here. You see, it's invested in all the stocks. But the team, the ESG team, ESG integration, right, says that you should not invest in that asset 20, not invest in that asset 23, right? Because ESG score is too low from my point of view. So that's what I say, I limit my investment universe. let's not talk about calculation, but what I would like to do is that new benchmark that is not invest in asset 23, in asset 20, I want that benchmark has the same structure as the first one, about the same property, right? I don't want to change it. So a way to do that, right, is when I reduce, I don't want to change the relative weight. So when I look at the weight, I just put the non-investment here, that percentage, or all the other, by keeping the percentage constant, and also the ratio between each stocks constant also, so that I keep the same structure by reducing. That's the main idea. Once I did that, I have the new return of that benchmark adjusted to ESG strategy, which is 0.94%, always positive, while the overall benchmark is 0.76. So it has an active return. I take the contribution, is the weight times the active return, and the difference of contribution is the ESG integration impact. You understood? Right, that's good for me, because that means that I can explain that to a client, and it makes sense also because I have some argument to say I didn't change the structure of the benchmark. I keep the same systematic risk if I want to go a bit deeper, right? So it makes sense, and then when I add all this contribution, right, I can have the impact. I will show you in a reporting in a moment. Now, second, the exclusion. The exclusion means that here I have the integration, then there is some sector that I do exclude, right? So exclusion means that in this industry B, I cannot invest. This industry B is, for example, fossil energy, a non-conventional weapon, etc. So I have to set all the weight in 0. Once again, doing that, the main idea, simple, I want to keep the same structure. Right? By removing some stock, I don't want to change the structure, which means when I take the ratio, you see here, I have the weight of the first benchmark, 22.47% that we see before. For another sector is 12.9. When I remove the weight here, I allocate in all the other remaining industry, and I want to keep all this ratio constant, so that I don't alter the structure of my benchmark. And once again, that's why we call it a successive benchmark methodology. Once again, doing that, right, I can measure the impact of this decision. Let's see a reporting. That's a real reporting on a real portfolio delivered by the system here. I mean this, we have the benchmark, let's say MSCI EMU full, right? The benchmark deliver 12.75%. Exclusion or negative screening, I exclude fossil energy, I exclude alcohol. Using that methodology, I did measure that the contribution is 0.4% minus 0.65%, which means that I have a difference of minus 25 basis points, okay? But the portfolio manager is not accountable for that if it's the asset owner who decide that. So I remove it from the equation when I will look at the strategic asset allocation and the tactical asset allocation. I don't want to look at that I explain, so I remove that. But when I put it best in class because I went on score, but the ESG integration contribute plus 0.53%. Here, in my example, that is also the asset owner. So the ESG return is 13.02. The portfolio return is 13.91%. Okay? So I have an excess return after correcting for ESG. I'm not looking at 13.91 against 12.74 without any constraint. I'm looking here in this example at 1391 to 1302. Okay? You see? Now we can decide if this is the responsibility of the asset manager or not, if I need to include it or not, right? You have to understand the investment process. And so, allocation, remember tactical asset allocation? I select different weight in different index, my budget, conviction or selection, They did contribute to explain that 89 basis point. So when I want to reconcile, I have the MSCI return, right? 12.74. Negative screening removes some performance. Integration or basic class adds some performance. Allocation adds some performance. Selection to end up with the portfolio return. You see, I have more information. I have more information than only an excess return. That's what I say, for me, it's meaningful because I can show to my client here some information. Then I can complete this information by industry, whatever. Okay? Okay, still, as I understood, I have 40 minutes. So still a couple of minutes to go. Yeah. Just a quick focus on the E. I will go a bit faster on that, but no, some call it the temperature of the benchmark. Maybe you're familiar with that. Means that what is the contribution to my portfolio to the Earth temperature? Or if you want here, what is the carbon footprint? That data is available today. Maybe not for all the scope. Scope 1, yes. Scope 2 is quite good. Scope 3, more difficult, right? But we have the carbon footprint today of every company. And also, thanks to the new regulation, company will have to disclose what they are doing to meet the goal of being neutral. Right? That's a new regulation of non-financial directive. Okay, that's kind of important. So I have the information. The idea for the portfolio manager is to reduce this carbon footprint. Right? That's the idea. What's the impact of return on that? Again, we can put a methodology in place. We see that investing in some stock by lowering the weight against the benchmark, always the same as carbon here saving in green. I did save some carbon here by lowering my weight in Imerys, Enel, Saint-Gobain, Axo. Some other company, I did overweight, and there I have a negative contribution. What's the impact on return for that? That's my question. And that's the only side that maybe matter because the methodology here may be a bit more sophisticated. But we have to understand that every company today has kind of a short position of the carbon emission. If you're familiar to the market, short position means that you are short today at 100. If the price tomorrow is 150, you have to buy back at 150 and you make a loss. Today, carbon is free, almost free. It's not free, there is some carbon certificate, but really, it's almost free. So that means that it's like every company has a short position at zero. And tomorrow, regulation will say, okay, you're not meeting the goal. You, as a company, you're not meeting your goal of being neutral. I will add some heavy tax on you. That's what I say, heavy tax means you will have to pay. So I will have to buy back my position at the cost of the tax. Okay? And so that will have an impact on the return. Just as an example, that's numbers of 2020. ExxonMobil, 112 million tons of CO2 per year, right? If I say, and that's not a number that is just not reasonable in the future. Today is zero, right? Or almost zero. But let's say in the future, if they're not doing anything, right? Maybe they will have to pay €100 or $100, which means that will be a cost of 11 billion, given that the yearly earnings are 8 billion. You see the problem, you see the impact on return on that stock could go down. And so that's all the idea of carbon emission. First, have another look at your portfolio. Instead of having a look of allocation, I have 20% there, 5% there, etc. I have a look on exposure to GIC, to CO2 emission, right? And the main idea is that could be translated into a return. What would be the impact in terms of return, right? So that I could measure that. And so the main idea is to have that what we call the carbon cost today, given that, but more sophisticated because it's not really today's emission that matters. It's what's the strategy of the firm to go neutral. That's the most important thing. I prefer a company with a huge emission that has a good plan to reach neutral. Sorry about that. Won't make it. Sorry. I prefer a company that has a large emission, but with a plan, right? Than a company with a low emission that just keep it like this. Okay, so into the calculation, when I say the carbon cost, I have to have a forecast of future carbon emission, future carbon pricing curve, that's why I say, to translate all this into a cost. Once I have a cost, I should say, okay, if they were neutral, that active return against the benchmark will be 83, while it is 98 today, 0.98. So I look at neutral, and I look at allocation and selection. Indeed, it's neutral, carbon neutral. So I have allocation and selection that does not depend on carbon emission. And you see that, I see that here, effective, I have 36.22. Means that what contributes the most is the allocation. Selection was about the same. The fact that on the specific stocks, I did select some stocks that did not have large emission, did not impact that portfolio, but allocating in different sectors had a huge impact. Okay? So that's all for today. The only thing that I can say, methodology is quite nice, right? We can have a research, that's my job at this, but also I think that you really need also the way to be able to do that. And thanks to this. A bit of commercial, at the end. Okay, so let's finish on this slide. Any question, or For me, yes. But I don't know what's the policy of this. People are asking for the slide, but you know what? Let's do it. You have here my friend Guy, right there. Ask him, he'll send it to you, right? Okay.